Now, Joey, thank you very much for being here. Let's talk first about just how bad it is in the commercial real estate market given COVID-19.
Good afternoon, Don. I would tell you it is obviously this is a pandemic and obviously a crisis for the entire country. I'll tell you, our tenants started the month of April taking a broad approach to opportunistically not paying rent. What we've come to realize is, unlike other landlords, we're the opposite of a shopping center or a mall owner. As you mentioned, Walmart, TJ Maxx, Best Buy. Our tenants' obligation is very clear. It's to pay their rent, and our obligation is to make sure that we don't breach quiet enjoyment and any de minimis property management responsibility. So obviously the consumer, especially discretionary spending, is far off from norms and is in a hole effectively. But we have a very clear obligation with our tenants and those contractual lease agreements.
All right, so let's talk then about, there's a difference, say, like you said, between Walmart, Best Buy, TJX, Tractor Supply, Sherwin-Williams, who are some of your top tenants, versus some of the other perhaps lower-tier operators that still have a business presence but maybe aren't able to pay those leases and that rent like the way Walmart possibly can. What exactly are you doing as a real estate investment trust to either assist them or find ways for them to actually try to stay in business?
So I say at Agree Realty, with that 900 properties you mentioned, we have very few small mom and pop tenants. We have tenants that are weighted toward the national retailers. We've been solely focused on investment grade, long-term retail winners in the e-commerce world, omni-channel world that we live in today. Now, if we have a small mom and pop tenant that doesn't have a private equity sponsor or a random one in our portfolio, we're willing to work with them to make sure in a partnership that they can get through this pandemic and this health crisis. But at the same time, our vast majority of our portfolio today, 60% is leased to investment-grade retailers. And like you said, it's the top operators in the business here. So we aren't working with many mom-and-pop tenants in context of our portfolio.
All right, there's been a theme that we've been exploring for the past few weeks now with regard to COVID-19 and the types of temporary or permanent changes that are happening to an industry. What exactly are the temporary and permanent changes happening to real estate given what's happened with this pandemic?
Well, I think the temporary changes are obviously we're seeing is consumer spending obviously dropped significantly. I think what is more important is to see through this pandemic, and by no means do I see a V or a U-shaped recovery, but to see through this pandemic in terms of retail real estate and consumer discretionary spending, and also on necessities, and where those dollars are going to go. And in my mind, given the backdrop of commercial real estate for the last 10 years, with one of the strongest economies we've ever had and a strong consumer, which makes it almost 70% of it, we're basically seeing the exact opposite in this pandemic. And now seeing through this pandemic into what could be a protracted recession, where those dollars go and what retailers, frankly, make it through this pandemic and live to survive. We're focused on those retailers that not only survive, but they will thrive in a post-pandemic recessionary environment.
All right, Steve, you've brought up real estate prominently earlier on in the show. How do you feel, and what exactly would you be asking a guy like Joey?
Well, in full disclosure, I'm a shareholder. I bought more when it dipped a little bit, and have owned it for a while. Joey, you're obviously seeing opportunity. You've raised a lot of capital just over the last few weeks, an incredible amount of capital. Where exactly do you see that in terms of regionally and in terms of the type of retailers that you're going to take on? And is that, as part of that question, is that reverse inquiry from like the Walmarts and the Walgreens and the Lowe's that are saying, hey, we want to put more stores up?
So, no, you're correct. We've had two highly successful equity capital raises totaling nearly $600 million in April, headlined most recently by the Cohen & Sears $370 million investment. And we have the ability to execute on well over $1 billion of acquisitions while maintaining a very conservative best-in-class balance sheet. I'll tell you, what we're preparing for is a market dislocation here at Agree Realty. And what we think is going to happen is frankly, the lack of liquidity in the debt and equity markets, the impaired cost of capital, is going to provide us additional opportunities with those Walmarts and the TJ Maxxes and the Best Buys and the Tractor Supplies, the National Tire and Batteries and O'Reilly and AutoZones of the world, where, frankly, our cost of capital, our tenant relationships, and our ability to execute with the great team that we have is really going to put us in a very unique position here.
All right, Kevin O'Leary, let's have you weigh in here. What would you would ask Agree Realty about something, given your view on the economy right now? What exactly is your thought, and what would you ask Joey about this?
I do have a question for you, Joey. You know, when we went into this lockdown, we were about 16.5% online sales to consumers, ex-autos. Coming out of this, let's say, you know, we're going to be locked down maybe to who knows when. I can't guess. No one can. I think we're going to be somewhere between 20 and 25%. I'm seeing this happen right now with my little portfolio of 50 companies, of which half their sales were retail. They're moving to an online direct-to-consumer model. We don't think that's going to change much. Speaking to your thesis, if all of a sudden a Walmart says to you, which is a AAA tenant for sure, look, we don't need 1 million square feet of retail space. We need half of it to be turned into a distribution center right on your lot, and you're going to pay the CapEx to convert it. Are you going to do that for them?
So it's a great question. First of all, we wouldn't pay the CapEx if that situation were to occur. Our tenants under effectively long-term duration leases. Our portfolio today is approaching 10 years weighted average lease term. Our pipeline and our focus has been heavily focused on the brand name retailers that frankly were brick and mortar retailers who cannot be disintermediated by the internet and technological strategies that will complement and enhance their physical store footprint strategy. To your point, the 16% sales that are currently online, it's going to be very interesting to see what that retention rate is and how that impacts different sectors and different tenants. So, for example, this country was at 1.5% e-commerce grocery penetration. Great Britain was at approximately 6% prior to this pandemic. What Amazon and Walmart and all of the grocery delivery services are now seeing is that they've been able to penetrate the probably the most difficult demographic segment in the country, and that is my parents, who typically don't want to shop online and want to be into the grocery store and look at the fruit and touch the vegetables and go to the produce and deli counter. And so it's a very different world we're going to emerge from. I think the other piece of that equation, and not to be elongated, is we're going to see significant contraction in GLA in this country. We have 24 square feet per capita of retail space in this country today. Your Canada has 16 square feet per capita. Western Europe's about 4.5. We're going to see a number of retailers file bankruptcy. And so where all of that consumer spend goes is not only online, but it is to the best and the brightest retailers. And that's what we're focused on, and that's what we've been focused on.
All right, big themes to watch for sure. Joey Agree, CEO of Agree Realty, thank you very much.